Welcome to the Honolulu, Hawaii Monthly Housing Report. I'm Patrick ONeill, Principal Broker at Luxury Homes International. And with me today, the president of TZ Economics and one of Hawaii's leading economists, Mr. Paul Brewbaker. Paul, aloha Monday.
How's it?
Good to see you again.
Yeah, nice to be
well, again, much has happened in the 30 days since we spoke last. And why don't we just jump right into the statistics just released by the Honolulu Board of Realtors. And pull this up here. So I thought we would start on maybe the headline of what's been happening. We'll take a look at closed sales declining again, and we can see 26% for single family homes, down almost 25% for condos compared to last year. Yeah. When we take a look at the year-to-date numbers, tracking negative, certainly it looks like this is going to finish up in the negative zone. And then, Paul, I want to take a look back, a little bit of yes.
The latest month is falling farther than the last several months, so it's pulling the year average down. Yeah,
that's right. That's right. Yeah. So it looks like we're clearly going to end that negative year to date on a higher number. I want to take a moment and just go back to 2019. It's sort of the pre-COVID correction, if you will. And can you kind of refresh our memory? What was happening in 2019 towards the end there?
Well, you'll remember that in 2017 and 18, the Fed had begun to normalize interest rates and take the overnight rate, which had been at zero for a long time, and as partly as a consequence of that, move the longer term interest rates like mortgage rates and longer term treasury yields, move them upward to something more consistent with its long-term objectives of 2% inflation, maybe 2% GDP growth. And in that world, something like a 3% neutral rate, so to speak, a risk-free nominal interest rate, and then maybe something like a 5% mortgage rate. That had happened in 2017, 2019, kind of soft breaking. And then financial markets became a little untethered, and the Fed had to step in. But the monetary policy changes had worked, and things were sort of slowing down, and people were starting to talk about, notwithstanding the fact that we were at the end of the longest expansion in history, but which we didn't know was the end, but partly because it was so long, you had to start thinking about what the end would look like. It did seem to as if there was a little bit of a pullback in investor confidence. And of course, the prices, which had risen steadily for all of the 20 teens, which, as I say, had risen for most of the decade, had actually also started to flatten out on Oahu in 2018, 2019. So that, as a general observation, there was a sense that investor demand was waning a little bit, that conditions weren't as supportive for higher home sales and higher residential investment generally, and that the possibility of recession and some of the waning of investor confidence that comes from a change in that mindset all were at work in those months prior to the pandemic.
Right. And clearly, I remember 2019, as far as the real estate markets were concerned, we were all talking correction. Prices were starting to drop, volume was starting to drop. So it's kind of interesting to take a look at how it compares. And then let me just draw a straight line here. And if we look at single family in the green line below, we're just below that. We're about 50 units below where we were on the closed sales volume back in August 2019. This chart is not seasonally adjusted, as I know that you will point out. Now, condos are exactly where they were at this time, which is, it's just sort of an interesting moment in time. And are we going to go back and start tracking along those lines? So let's take a look at the next thing, which is going to be the pending sales. So the harbinger of things to come, so to speak.
Right.
And here we go. Of course, it's down 24 and 23%. And I'll point out, this is the 5th consecutive month. This started back in April. So I think we're going to expect more of the same. Would you agree in the pending sales drop off?
Yeah, and as with the case of closed sales, you can see that the latest month, August, has a bigger decrease than the prior months, than the year-to-date months cumulatively. So each new month is leading the year downward with bigger decreases.
Yes. Yeah. And let's just take a look at a very dramatic change in active inventory for single family homes. I mean, that's 43%. Condos, not so much 13%, but it's still
Yeah.
up in the inventory. And then I thought, let's take a look again, kind of going back to this historical perspective, heading back to 2019, pre-COVID. And when you look here, I mean, what does this show you? You're looking back at 2019, you see where we are. We're almost half the inventory that we had in 2019. What do you think this sort of indicates for the future?
That's not a bad benchmark for where things might end up later this year, next year. Actually, I mean, if you think about what's unfolding, it's this a similar kind of a slowdown on the demand side of the housing market. And so when you see the demand wane, the number of people listing homes are essentially piling additional units into an active inventory that's not moving, right? It's like water in a bathtub. The water coming into the bathtub is not being drained out as fast as it was before. So the level is rising.
So
It's not, sorry, go ahead. Yeah.
So potentially, who knows, but potentially you're saying that maybe we're going to head back to those more normalized inventory rates, so to speak, as we head into the future.
Yeah, you think of this as a U-shaped trajectory. If you push out to August of 23, or sometime in 2024, you get out to where the configuration we're seeing here is a U. What the bottom of the U represents, what that period from the summer of 2020 to the winter of 22 represents, is a period with an extraordinary increase in demand and maybe the same flow of units into the bathtub. And so when that demand, when the water rushing out is the water coming in is same, and all of a sudden there's a big whoosh, everybody wants to buy a different home for whatever reason.
Yes.
That inventory goes down, and then as we go back to a more normal kind of environment. Now, what was different about summer of 2020 through winter of 2022? It's the pandemic, stupid. I mean, something happened that changed housing preferences that led to this extraordinary burst. True, lower interest rates, which again were a response to the pandemic, were part of that configuration. But something deeper happened, I think, even without the lower mortgage rates. Something happened that led people to shift their housing preferences, that led to an increase in demand for single family homes that drew down that inventory much more rapidly than was the case for condos. But now, on the way out, condos are still the affordable segment.
Yes.
And if you've gotten your vaccinations and you feel like the world's a little safer, and living in a multifamily dwelling does not pose the same biological risk that it might have 2 years ago, maybe a condo, which fits your budget, is the place to go. So I think that's also lurking in these data.
Yes. And we've been adding some inventory, at least to the condo market. I know it's historically low, as opposed to the single family, we really haven't been adding much new inventory.
Not like we used to.
Yeah, not like we used to. Okay, well, Paul, let's take a quick break. And when we come back, let's talk about inflation, and in particular, interest rates. The Fed's scheduled to meet in about 10 days. So stand by.
Okay.
We'll be right back with economist Paul Brewbaker.
Cool.
Okay, and welcome back. We're here with economist Paul Brewbaker. And Paul, we're going to talk about inflation and interest rates. But before we do that, let's talk about pricing. What do you see? What's happening out there in the pricing world? We're seeing increased inventory. We're seeing decrease in sales. Maybe that will point towards some sort of price correction.
Yeah, in fact, it seems to be happening contemporaneously. And as you say, you can find the data in the Honolulu Board of Realtors monthly reports. However, in both sales volumes and certainly in prices, there tends to be a seasonal variation that's worth taking into consideration. And so what I do is I transform the raw data published by the board and pull the seasonality out so that essentially so that an August statistic, as we're looking at the end here of this time series, is being compared to other Augusts and so on, and Julys to Julys and so on and so forth. A couple of things stand out right away. The first is this peak looking configuration for single family home prices: August, July, June, May, maybe spring was the peak for all single family homes. That's kind of interesting. That's looking like, it happened here, and this was a bit of a head fake. And you and I talked about this last fall. Turned out it was premature. This could be a head fake, but I don't know. You're getting to a point now where, yeah, with interest rates 3% here, interest rates almost 6% here. I'm thinking this downturn is a little more likely to persist.
And clearly with that, the single family, that is so far above the long-term trend line.
Yes, this is the trend from 2012 to 2018, which we were just talking about earlier. The trend in the 20 teens was very stable, like an escalator, just going up at the same rate every year, 4 or 5%, maybe 6% on the neighbor islands, from a deeper hole after the subprime bubble burst and the financial crisis and the Great Recession of 2008, 2009. So deeper hole on the neighbor islands, deeper hole to climb out of, but on Oahu from a shallower hole, 4 or 5% annual home price appreciation every year. Unwinding, unraveling a little bit after mid 2018, you can see that single family homes and to some extent condo prices also took a bit of an off ramp and went on the, what do they call, the service road on the side of the freeway here for a few years. Comes the pandemic, everybody goes into hiding for a couple months, and then this explosive post-pandemic period, which this is sort of the third thing to be aware of, while it affected home prices generally, condos worked their way back up to trend, it affected single family home prices disproportionately. So something happened, right? In a bubble, all prices move in the same bubblicious manner, single family and condo. In a stable market, all prices appreciate at roughly the same rate, maintaining their relative, the relative differential between detached dwellings and multifamily dwellings on average, so to speak, or at the median, which is what we're looking at here. But the fact that single family home prices elevated so rapidly and so much relative to condos in fall of 2020 through winter of 2022 means that something specific to that type of dwelling was happening, specifically associated with the post-COVID changes to the structure of the economy, and as a result, buyer preferences. And I think it was remote work. And there's some evidence to suggest that up to half of the price appreciation in single family home prices across the country was a consequence of this one-time realignment of how many people go to the workplace and how many people work from home and how much hybrid work arrangement becomes the new normal. We're done with that. We're probably
right. And you and I looked at this before. The last time we saw the type of price appreciation that we saw in single family, which is over 20% annually, the last time was the subprime period,
was a subprime bubble,
right? And prior to that was the Japanese bubble.
It was
period.
the Japan bubble.
Totally different circumstances, but in both of those, then you do see some sort of correction back to that long-term trend line.
Well, you do see a correction, but let's remember, in a bubble, what's notable about a bubble is the absence of a fundamental economic explanation, motivation. Whereas here, we have a very specific fundamental economic structural change with which to explain single family home prices going up. The fact that people moved to detached dwellings because of the presence of biological risk and moved away from multifamily dwellings where they had to share elevators. That presence of a fundamental factor, and the fact, therefore, that the bubble only affected one side of the market and not as much the other means that it's not a bubble. Something really happened. And so in terms of where things go from here, that's kind of hard to say, because it's possible, for example, that where prices are right now as of August, that they just go back to that parallel trajectory, that they don't go back to the 20 teens trajectory, that they remain above that trajectory on a parallel path.
Mm-hmm.
I don't know. I'm just saying
One possibility. The
that's one
other is
possibility.
it does correct back to long-term trend. The other is it overshoots. I
And
suppose.
another way of saying what you're saying is, if you just think about projecting that path forward, we would have been at 1.1 million sometime in 2024 or 2025 anyway. So it could be the single family homes adjusted in the moment because of an extraordinary one-time change in the nature of the workforce and utilization of conventional workplaces, waits at this new, maybe subsided level slightly until it reconnects to the trend.
I see.
Gets back on the path.
So looking at this right now, you could read into this that it looks like a little bit of a peak and maybe starting to correct, or as you called it, potentially just a head fake. It's a blip, and now we just sort of flatten out.
I think it's much less likely now to be a head fake than it was a year ago when we actually saw a head fake and we're kind of prematurely calling the game over. Well, we went into extra innings, and now we're looking, like, bottom of the 14th and
long game.
I know, long game.
Yes. All right.
Here's another thing. This is Oahu, but we're seeing a similar phenomenon. Oahu in the lower right-hand corner. We're seeing a similar phenomenon across the neighbor island counties as well. More robustly on the Big Island, which is kind of interesting, but to a certain extent on Kauai maybe as well, and maybe a little more than Maui, although we'll see. Now, these are quarterly data through the second quarter. So I don't even have, I take that back. What I've done is I've used July or August as a proxy for the third quarter, and I've added that in. So to be continued, we'll see where this goes.
Okay. Very good. Okay. Paul, let's take just a real quick break. We come back. Let's talk about inflation and where interest rates are headed. Okay. So stand by. We'll be right back with economist Paul Brewbaker. Hello and welcome back to the Honolulu, Hawaii Housing Report with the economist Paul Brewbaker. And Paul, we're just about to talk about inflation and where interest rates are headed. I think the Fed is going to meet in about 10 days from now. They're signaling perhaps another 75% basis point increase. What's happening right now in inflation? Is it starting to trail off? And how is that going to impact the mortgage interest rates going forward?
It's important to remember that inflation is really coming from two separate channels of influence. One is on the aggregate demand side of the market, which is, the recovery has brought back consumer and investor demand. But of course, relief programs and stimulus checks and whatnot, extended unemployment insurance, which built a bridge across the chasm that was the pandemic recession, have put households and investors in a continuing strong position, and the demand for assets and for goods and to some extent services, goods more than services, has led to the inflationary pressures that we now see. But there's also a supply side of the problem. That increased demand for goods in particular has come into conflict with the fact that supply chains have been jammed up or disarticulated because of the global pandemic. Now, recovery in production and transportation and distribution gradually will bring demand and supply into alignment. But for now, many prices, fuel, foods, new and used vehicles, because of a shortage in semiconductors, have shown up prominently in the inflation statistics. And the Fed, in responding, as you point out, with higher interest rates, by the same token that through the same channels that it tamps down housing demand and residential investment generally, tamps down economic activity in general. So the same inverted U-shape we see in those single family home prices, not so much condos, but in the single family side of the market where a lot of energy went post-COVID, let's say partly because of remote work, is also being reflected in the inflationary pressure more broadly, not just in housing, but more broadly, beginning to abate. Just the inklings of that turning point in inflation measures for the US at a higher level than in Hawaii, just an inkling of the turning point began to emerge in the late spring and summer. And if you look at the Fed's preferred measure of inflation, the one upon which they base their target, which is actually the core personal consumption deflator. These are consumer price inflation rates, the Urban Hawaii Consumer Price Index measure of inflation. But the personal consumption expenditure deflator, slightly different measure, tends to run a little lower, tends to run a little cooler than the urban inflation measures. Also is showing a bit of a peak when you strip out the food and energy, when you look out at the core part of the inflation that excludes the volatile supply side factors.
This is for people who don't eat food or use gasoline.
For people who don't eat or drive. That's correct.
Got it. Okay, yes.
And the problem is that those components, when they go up, everybody complains. When they go down, nobody says anything.
Don't talk about it, right?
Don't talk about it.
Yeah, that's right.
And, I mean, if you think about it, why are Americans obese and diabetic? Because food has gotten cheaper and cheaper and cheaper for the last 80 years. And that's just a fact, Jack. So, and you bought a pickup truck 10 years ago when the price of oil was $100 a barrel. What's the price of oil today? $100 a barrel. There you go, genius. So right now, inflation is just beginning to come down. The Fed will continue to maintain a vigorous headwind generating posture by raising short-term interest rates to tamp down the pressures that have built up in the economy, particularly on the good side of the economy, particularly in fuel and food. And the Fed can't control drought and extreme heat that's affecting crop cycles. The Fed can't control the Russian invasion of Ukraine, which is affecting oil prices. But the Fed is doing what it can do to get back to its goal of 2% inflation, which you see there, I've highlighted at the bottom of the graph.
Mm-hmm. Okay, and so as we look then towards the mortgage interest rates, which generally the bond market would be building in these perceived signal increases. I think you and I looked earlier, the current Freddie Mac 30-year is at 5.89. What do you think is going to be happening with mortgage interest rates as we head into the remainder of the year?
Well, we can segue right to the interest rates from inflation, since they're actually related, right? Part of what you see in the term structure of interest rates is actually an inflation expectation. If the expectation of inflation is, let's say, 2% in the long run, 4 or 5% in the short run now at the core, 6 or 7% if you include food and energy. The idea is to get those elements to come down so that the expectation of 2% inflation is fulfilled. In a world in which it has been fulfilled, or equivalently, one in which people have confidence that the Fed will achieve their goal and allow expectations to remain well anchored in the terminology that Jay Powell and other Fed governors have tried to use. And it's important. Language is signaling. They're giving you forward guidance about where they intend to go. Well, in that kind of a world, then interest rates should, in the long run, in terms of treasury yields, which are the risk-free yields, gravitate towards something like 3%, while the overnight interbank lending rate is a little lower, let's say 2.5%. And the Fed's own guidance is that they expect the overnight rate to go up to maybe 4%, 3.25 next week. Sorry, I'm going to cough, so let's see if I can mute myself. I can't, so sorry. The Fed will act probably to fulfill the expectation it's already built that they go to 3.25 right here, where I'm shaking the arrow, and then maybe slow down a little on the rate increases to find where the top is going to be. And in that kind of a scenario, you would expect that mortgage rates will have followed this rapid ascent of the treasury yields to a point, you know, in a range of 5 to 6%. Right now we're at 5.89. At the end of August, we're at 5.5.
Mhm.
So it's bouncing around in this range until it settles down. But you know, we may eventually settle down in the neighborhood of 5 or maybe under once things play out over the next 18 to 24 months.
Understood. Okay, so we're probably see in the short term some continued increases on the mortgage interest rates.
Yeah.
Maybe bouncing up to even close to 6, and then slowly we'll see that hopefully retrace back down as we head forward.
Yeah, I think that's a fair expectation, and one that's widely held. I'll just mention that since we were talking about since it's an opportunity to talk about the direct linkage between the role monetary policy plays and mortgage interest rates, forward guidance, the signaling I talked about, is one important part of the Fed's monetary policy toolkit. So communication strategies. Another important part, and the traditional part, is moving the short-term interest rate around. But a third part is so-called quantitative easing or quantitative tightening in the current environment, wherein the Fed buys assets, creating liquidity in the banking system, and by bidding up the prices of those assets like treasury bonds or mortgage-backed securities, allows for lower interest rates to attach to those securities. And you can see some of that right now if you look at the Fed's balance sheet. So on the top of the balance sheet are the assets, and on the bottom are the liabilities. When the Fed buys treasury securities, the light blue portion here, or when it buys mortgage-backed securities, the darker blue segment, and the Fed holds 2.7 trillion in mortgage-backed securities right now. When it buys those securities on the asset side of its balance sheet, it pays for those securities by writing a check to the banks from which it has acquired the security. So it creates liquidity either through reserve deposits. It injects directly into the reserve deposits of those banks. We're in a phase now where the Fed is going to allow those securities to roll off the balance sheet. About, I'm going to get this wrong, it's 95 billion total. I think it's 60 billion per month in treasury securities and 35 billion per month in mortgage-backed securities. It's not selling securities, which would lower their price and bid up the yields, but it's allowing securities that mature from the asset side of their balance sheet to do so without replacement.
And that the effect on the mortgage interest market will be what?
More mortgage-backed securities than there would have been if the Fed were replacing its holdings by buying its maturing holdings by buying newly issued mortgage-backed securities. And as a consequence, less support for new issuance. The new mortgage-backed securities, which support the underlying mortgage lending, are going to have to be absorbed by private investors without the Fed's participation.
So less demand, rates will go up.
That's, well, less demand that keeps the mortgage-backed security prices up and allows the mortgage
rates go down
to be lower.
Sorry. Yeah, that's right. That's great. Yeah, got it. Okay.
But the key is that a little bit of additional wedgy upward pressure on mortgage rates from the absence of support that the Fed previously was providing.
Is that the technical economic term, a little bit of a wedgie? Upward wedgie?
A quantitative tightening.
Okay. All right. Okay. So Paul, let's wrap up. We're going to do now. Last month, you had all correct answers in the double bonus lightning round. Okay. So here's your answers: higher, lower, about the same. Okay.
Okay.
So inflation a year from now.
Lower.
Mortgage interest rates.
A little lower if we're lucky.
Okay. Single family home prices.
Not much lower.
Okay. About the same. About the same.
Well, of course, you don't have to sell your house, right? You can just sit in it and wait for another day.
Okay. Condo prices.
I'm going to say a little higher.
Okay. Well, Apparently, ding, ding, ding. You got all those
Ding,
right
ding, ding,
again.
ding, ding.
Congratulations. You're a winner once again, Paul. Well done.
And you win absolutely nothing.
Nothing at all. That's
As
right.
what's his name on public radio always does that. He's the
Yeah.
news guy.
Yes.
Anyway.
Well, hey, Paul, it's always such a pleasure. Really enjoy getting your insight and everything that's happening in the marketplace. And for those of you who are watching this on a video, please consider giving Paul a thumbs up down below. And if you want to get the next market update, consider subscribing to the channel. So that's it for today. Stay safe, be well, and aloha.
Aloha.